This dashboard tracks two very different ways of measuring reality in October 2004. On the left, you see the traditional media polling data for the upcoming presidential election, chaotic, fluctuating, and struggling to pin down a clear signal. That signal was meant to measure the precise odds of Democratic challenger John F. Kerry defeating the incumbent George W. Bush. In a tight race, standard polling models were struggling to provide mathematical certainty. But a small group of academics at the University of Iowa built an alternative mechanism. They created the Iowa Electronic Markets, a real money trading platform operating outside the jurisdiction of traditional commodity regulations. You didn't find Wall Street quantitative analysts operating here. The participant pool consisted predominantly of retail traders and university students, putting up very small amounts of capital to back their political forecasts. Yet, this decentralized network of amateurs produced more accurate predictive data than multi-million-dollar polling organizations. The Iowa system is a working example of an information market. Rather than trading physical goods, participants buy and sell contracts that pay out based strictly on the outcome of an uncertain future event. While it resembles a betting pool, it functions as an epistemic tool. It forces dispersed knowledge out into the open by putting a direct financial premium on accuracy. By requiring individuals to back their private beliefs with cash, the market distills collective intelligence into a single clearing price. This turns vague sentiment into a precise data point, offering a mechanism that may allow us to better evaluate complex social outcomes. This digital contract outlines a binary trade, paying $1 if Kerry wins, 0 if he loses. There is no partial credit. The order book shows buyers at 38 cents and sellers at 40. The market clearing price sits exactly centered at 39 cents. Now, introduce a hypothetical trader into this scenario. This trader has conducted private research suggesting Kerry actually has a 50% probability of winning. The trader's subjective belief of 50% is 10 points higher than the market's objective price of 39 cents. This chart plots expected value to illustrate the arbitrage incentive. If the trader is right, a 39-cent contract is mathematically underpriced compared to a 50-cent expected payout. Acting on this statistical advantage, the trader executes a massive buy order. As those buy orders hit the ledger, they consume the cheapest available contracts. This localized buying pressure drives the overall market price upward until the statistical advantage is closed. The price movement halts when it matches the aggregate consensus belief of all participants in the system. The financial incentive aligns the market price with the aggregate probability. In this structure, price is probability. This split-screen diagram contrasts two decision-making methods. If markets are efficient, why rely on expert committees? Cass Sunstein identifies a flaw called deliberative failure. In meetings, an authoritative speaker triggers an informational cascade, creating a consensus built on social pressure rather than independent analysis. This leads to group polarization. Deliberative bodies often shift toward more extreme versions of their initial positions to maintain cohesion. Then there is the hidden profile problem. Imagine a junior analyst holds contradictory, accurate data that challenges the room's consensus. Social friction, hierarchy, and fear of reprisal almost always suppress the revelation of that vital piece of data in a traditional setting. The market model removes the boardroom. Because the trading environment is anonymous, there is no social friction to expressing a dissenting view. In fact, the market financially rewards the holder of the hidden profile for betting against a flawed consensus. When that junior analyst buys contracts on the open market, their independent trade adjusts the collective price. The system absorbs their knowledge without requiring a single meeting. Information markets bypass cognitive bottlenecks. They trade the psychology of human deliberation for the mathematics of economic aggregation. Because information markets are built as open mathematical structures, they are inherently vulnerable to specific types of economic exploits. The primary vulnerability analyzed by researchers is systemic manipulation by bad actors. A political operative might intentionally buy bad contracts at a loss just to artificially inflate a candidate's perceived odds in the media. But the research yields a consistent result. These manipulation attacks almost universally fail to maintain their artificial price points. That failure is due to the market's internal defense, the arbitrage response. An artificially inflated price serves as a financial beacon for objective, profit-seeking traders to enter the system. Seeing an overpriced asset, those objective traders short the inflated contract. They correct the price back to its baseline, and in the process, drain the manipulator's capital. The act of manipulation creates the economic incentives that destroy it, giving information markets a resilient structural immune system. Limiting this tool to predicting political elections misses its broader utility for active decision-making. Initiatives like the Copenhagen Consensus are looking at how to effectively set priorities for global economic development. Instead of tracking candidates, contingent contracts can be written for macro policy. A market can pay out only if a specific regional GDP target is met. This allows governments to harness collective intelligence, pricing a policy's exact probability of success before allocating billions of dollars. Traditional development relies on an opinion-based model, insulated experts debating in boardrooms, influenced by political posturing and systemic biases. We can supplement that with a performance-based method, where funding is tied to the objective forecasting of the open market. We know the mechanics hold up. Weeks before the ballots were cast, the traders on the Iowa electronic markets had already aggregated the truth of the 2004 election. Information markets represent a breakthrough in design. They provide a structural framework to filter out the noise of human deliberation, leaving only the signal of mathematical truth.